There's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back in its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an eightfold bull market to get to those highs. We're only fourfold right now. So the game is not over. The game is just beginning. Watch the spreads.
According to Michael Oliver of Momentum Structural Analysis, the true changes occur in silence, contrary to the belief held by most investors that markets only move when headlines blow up. Silver's quiet consolidation at the moment is a sign of strength rather than weakness. The momentum indicators at the heart of Oliver's strategy are showing the same early warning signs that preceded silver's most recent significant rallies beneath the surface. He notes that silver has been building a tight foundation that could lead to an abrupt breakout by pressing against a crucial resistance level for weeks. History indicates that if it pushes sharply higher, the increase could be forceful rather than gradual. Oliver claims that the way silver is acting in comparison to gold is even more telling. One of his favorite leading indicators, the silver to gold ratio, is about to break out. Historically, this pattern has signaled the beginning of powerful bull phases. Oliver thinks the true narrative is developing quietly, creating what may be one of the biggest opportunities in the precious metals industry, while most traders are preoccupied with short-term noise. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing.
Your view changed at all given the extent of the pullback we've seen?
No, the pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week, and I'm gonna break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to $40 or 41 or whatever, and this is this or that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold. The spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. Did anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, oh, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued, and investors just say, phooey with that market. It's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say look at the silver-gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from like above 1.2 to 1.32% to be precise, to break out, momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. So anyway, enough said on that, but that's what I would look at.
According to Michael Oliver, another significant signal is emerging beneath the surface, this time between gold and the US stock market. Since 2013, gold has had difficulty keeping up with the S&P 500, particularly during the years of market expansion. However, that long-term trend may be ending. Oliver cites the gold to S&P 500 ratio, a graph that shows how gold does in relation to stocks. This ratio has reached the same resistance level 3 times in the last 10 years. At roughly 58%, it is currently testing that level for the 4th time. Oliver claims that if gold closes a month at or over 60%, it will confirm a clear structural breakout, which is an indication that gold is beginning to significantly and sustainably outperform stocks. This wouldn't just be a temporary gain, he claims. Investor confidence would shift from paper assets like equities to tangible ones like gold, marking a true turning point. Show some love by hitting the like button, subscribing to the channel, and turning on notifications. Now, let's get back and hear his following words.
There should be a lot more upside in both metals.
When that spread breaks out, it says something's beginning. Okay? It's not saying, it's over. It's saying the race just began. And there's another spread that's very, very important. And that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since a guy should go back 11 years now, but from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. It's now for the 4th time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5%. Price of D gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI, tech related. NASDAQ 100, the same symbols, 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, et cetera, far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back in its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an eightfold bull market to get to those highs. We're only fourfold right now. So the game is not over. The game is just beginning. Watch the spreads. Well, there's still, you could tell by looking at the hour by hour action sometimes of silver and gold versus the S&P, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay, they're making a mistake. Okay, but you can see it in the hourly ticks where the short-term traders say, oh, S&P just dropped 5, let's sell silver off, it drops 25 cents, and the game is going on still. It's a wrong thought process, because when you stand back and look at the bigger picture, take for example, S&P made a high January, February, collapsed into April, 20% drop. What did gold do during that time? It exploded, not hour by hour, but month by month, okay? So S&P had a sharp, cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like, and yet gold went up, okay? So people need to rethink that assumption because it will trap them into missing something.
According to Michael Oliver, a significant signal between gold and the US stock market is currently developing, which may signify the start of a significant change in world assets. According to him, a spread or ratio does not necessarily indicate the end of the trend. It indicates that it is just beginning. Oliver carefully examined the gold to S&P 500 ratio, a graph that shows how well gold does in relation to stocks. Gold had been doing poorly since about 2013, particularly during its drop into the lows of 2015. However, since then, that ratio has created a robust ceiling that is currently undergoing its fourth test. He clarified that this breakout would indicate the beginning of a significant asset class shift as money starts to flow from equities to tangible assets like gold rather than the end of a bull run. The S&P 500 and NASDAQ 100 are dangerously distorted, he added. Nearly 1/3 of the index is made up of a small number of IT heavyweights, including Palantir, Nvidia, and other artificial intelligence businesses. The market has been dominated by these few firms, and when they start to decline sharply, the underlying weakness becomes evident. Oliver claims that the breakout has already occurred when comparing gold to other indexes, such as the Dow Jones 30 or the New York Composite. This indicates that the change has already started. Silently, gold is beginning to beat the whole stock market, which has historically always resulted in substantially higher gold prices. That's why, in Oliver's words, the game is not over, it's just beginning. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.